Welcome to the Dep Dive. Today we're getting straight into BlackRock's first quarter 2025 financial results.
Right.
You, our listener, flagged this report for us. It's up on rlar.blackrock.com. And our aim is really to pull out the crucial insights.
Yeah, figure out what's going on.
Exactly. Understand the heartbeat of this financial giant and the broader market. Focus on what really matters, why it matters, and, keep it clear.
Makes sense.
Yeah.
And this report, it covers the first 3 months of 2025, so ending March 31st.
Got it.
And you'll see both standard GAAP figures and adjusted non-GAAP numbers.
Right. Companies often do that. Why the adjusted figures again?
Well, they usually say it gives management's view of the sort of core ongoing business performance, takes out things they see as maybe less typical one-offs, that kind of thing.
Okay. So drilling right down then, some of the headline numbers are pretty striking.
Yeah?
We're looking at diluted earnings per share. That's the profit per share coming in at $9.64 GAAP, but $11.30 adjusted.
Yeah, that adjusted figure definitely stands out, doesn't it?
It does.
And what's really significant, I think, is the sheer amount of money flowing in.
The inflows.
Yeah, BlackRock pulled in a total of $84 billion in net inflows just this quarter.
$84 billion. Wow.
To put that in perspective, that's 3% annualized organic asset growth, which, considering how massive they already are,
Yeah.
well, that's a lot of new money.
Absolutely. And the revenue picture looks interesting too, up 12% year over year.
That's right. So yes, significant new money coming in, overall revenue heading up.
Okay, so let's start digging into what's, powering this growth. What were the main engines here?
Well, a key piece was a record first quarter for their iShares ETFs.
iShares, okay.
Yeah, those exchange-traded funds, they're clearly, still super popular. Investors looking for efficient ways into different markets.
Right. Seems like that trend towards ETFs, often lower cost, easy to trade, that's not slowing down.
Not at all. But it wasn't just ETFs. They also highlighted strong inflows into private markets.
Interesting. What does that tell us about investor appetite right now?
That's a really good point. Private markets think private equity, infrastructure projects, that sort of thing. They often appeal to investors looking for potentially higher returns.
Right.
Maybe different types of assets you can't get on public exchanges.
Right. Less liquid maybe, but different opportunities.
Exactly. So the strong inflows there suggest investors are still, hunting for those kinds of opportunities.
And here's where it gets really interesting for me. The report also points to active net inflows. So even with the huge passive trend, some of BlackRock's actively managed funds are still bringing in cash. What might be driving that?
That's a great question.
Yeah.
It could be that in certain areas, certain asset classes, investors still believe, skilled active managers can actually beat the index.
Makes sense.
And on top of that, they had broad-based organic base fee growth. Now, base fees, that's the recurring revenue they get just for managing the assets, right?
The bread and butter, yeah.
Exactly. And the fact that this growth happened across different bits of the business, private markets, ETFs, and their systematic active strategies, that suggests a real fundamental strength. It's not just one thing propping them up.
And that 12% revenue jump we mentioned, sounds like acquisitions played a big part there too. The report mentions the GIP transactions specifically. Remind us, GIP.
GIP is Global Infrastructure Management. BlackRock bought them late last year, October 2024. Big move into infrastructure investing.
Right.
So the fees from managing those new assets, they're definitely boosting the revenue numbers now.
Sure.
They also mention higher tech services and subscription revenue. We'll definitely get more into that, driven by Aladdin and the partial impact of the Precon transaction.
Yes, Precon, that deal just closed, right? Early March.
Yeah, March 3rd, I think.
Yeah.
And they even gave a number for about $20 million in revenue from Precon just in Q1.
So it really looks like acquisitions are a key part of the strategy, not just organic growth.
Exactly. You connect the dots. It shows BlackRock is actively diversifying, expanding beyond just traditional asset management with these deals.
Now, let's circle back to this technology aspect because it keeps coming up.
Right.
Significant growth, right? Tech services and subscriptions up 16% year over year.
Yeah, what's fascinating here is Aladdin, their big proprietary platform for risk management investment tech.
The one they use themselves, but also sell to others.
Precisely. They use it for their own massive AUM, but they license it out too. So its growing adoption is becoming a really significant revenue driver on its own.
And like we just said, the Precon deal adds another layer to this tech revenue. It feels like they're building a serious fintech arm alongside the investment side.
That's exactly how it looks. And for future potential, look at their annual contract value, ACV.
Okay, what's ACV again?
Think of it as the annualized value of their subscription contracts, sort of a forward look at recurring revenue.
Got
Including Preqin, their ACV jumped 30% year over year. 30%. Even if you take Preqin out, it was still up a healthy 14%. That really points to continued strong growth in tech.
So, okay, growth drivers, tech looking strong. How does this all translate to the bottom line,
Yeah.
the profit? Because the GAAP numbers looked a bit mixed at first glance.
That's right. GAAP operating income was up slightly, just 0.3%, but GAAP diluted EPS actually decreased by 8% compared to last year.
Down 8%, why?
Well, the main reason seems to be the impact of those acquisition-related costs we talked about, GIP, Preqin. Those deals have upfront costs, integration costs, and they're hitting the standard accounting profitability right now.
Ah, okay, that makes sense. So if we look at the adjusted figures, which strip out those costs, what's the picture there?
The adjusted numbers tell a much stronger story. Adjusted operating income was up 14%, and adjusted EPS up 15% compared to Q1 last year.
15% adjusted EPS growth.
Okay. Yeah. Now, that adjusted EPS also got a bit of a boost from a lower effective tax rate this quarter, but that was partly offset by lower non-operating income and a slightly higher share count. But still, taking out those deal costs reveals stronger underlying profit.
And what about shareholder returns? Always important.
Right. They reported buying back $375 million of their own shares in the quarter,
Share repurchases. Okay.
which can help boost EPS, fewer shares outstanding. And they also bumped up the quarterly cash dividend by 2% to $5.21 per share.
So signaling confidence, returning cash to investors.
Seems to be the message, yeah.
Now let's get the view from the top. Lawrence Fink, the CEO, his comments are always closely watched. What were the key takeaways from him?
He sounded pretty optimistic, definitely.
Yeah.
Emphasized BlackRock's position, client connections are stronger than ever. He pointed to that 6% organic base fee growth as their best start to a year since 2021.
So framing it as fundamental strength despite, market wobbles.
Exactly. He talked about secular strength against a complex market backdrop and helping clients navigate, all the shifts in markets and policy, focusing on long-term growth opportunities.
Did he mention their global reach?
He did. He used that phrase global firm, but one that operates hyper-locally, highlighting their network, serving clients worldwide, trying to position them as a sort of stable partner in uncertain times.
And what about the vision for BlackRock itself? Where does he see it going?
Yeah, he was quite explicit there. Said they're building a premier global public-private markets investment and technology firm.
Investment and technology. Interesting phrasing.
Right. He really underscored their leading spots in private markets, ETFs, and Aladdin. He expects those areas to really benefit from capital flows going forward, maybe even if public markets are choppy. It's a picture of a much more diversified financial powerhouse.
It definitely sounds like an evolution beyond just being a huge asset manager. He used the word convener, too. What was that about?
Yeah, convener. He seemed to suggest that BlackRock offers stability and maybe optimism for clients dealing with uncertainty, that their whole package investment know-how, products, tech becomes even more valuable in these kinds of markets.
Okay, let's dig a bit deeper now into where the money's actually moving, the flows, geographically for starters.
Right, so long-term net flows by region, the Americas led the way, pulled in $51 billion. EMEA, that's Europe, Middle East, Africa, brought in $36 billion.
Okay.
But interestingly, APAC, Asia Pacific, actually saw a net outflow of $4 billion.
An outflow from APAC. That stands out, doesn't it, given the growth narrative there?
It does. The report doesn't spell out why, but you could guess maybe regional economic factors, specific investor sentiment shifts over there. Just shows global flows aren't always even.
Good point. Okay, what about who is moving the money? Client types.
Right. So ETFs, as you said, just huge inflows. $107 billion. Massive.
Wow.
Retail clients also positive. $13 billion net inflows overall. That split was $8 billion in the U.S., $6 billion international.
Okay, retail's still coming in.
Yeah. But the institutional side saw a net outflow of $37 billion.
Institutions pulling money out. Overall.
Overall, yes. But here's the interesting part. That outflow was mostly driven by index products within the institutional space. Their active institutional products actually saw $8 billion inflows.
Ah. So institutions are maybe trimming broad index exposure, but still allocating to active managers.
Seems like it. Suggests maybe a shift in how some big investors are thinking right now.
Interesting.
And that's kind of reflected when you look at flows by investment style, too. Active overall saw $9 billion in ETFs, the $107 billion. But non-ETF index strategies saw a big outflow, $34 billion out.
Okay. And cash.
Cash management was pretty flat, just a $1 billion net inflow.
Right. And drilling down even further, which types of assets were most popular this quarter? Stocks? Bonds?
Fixed income actually led the way, pulled in $37.7 billion in net inflows.
Bonds showing strength.
Yeah. Equity followed with $19.3 billion. Alternatives, things like private equity hedge funds, saw $9.3 billion in, and a big chunk of that, $7.1 billion, was specifically private markets.
Okay.
And also worth noting, digital assets, $3.3 billion in net inflows there.
Digital assets attracting real money. That's definitely a sign of the times.
For sure.
Okay, let's talk about the really big number, assets under management, AUM. Where does BlackRock stand now?
It's staggering. End of March 2025, AUM hit $11.58 trillion.
Trillion. Wow.
Yeah, that's up 11% from the same time last year. And their average AUM for the quarter was even a bit higher, $11.69 trillion, up 15% year over year. Just immense figures.
$11.5 trillion. It's hard to even picture. How does that break down? What kind of products is that mostly in?
Well, equity is the biggest piece, $6.20 trillion. Then fixed income at $3.01 trillion. Multi-asset strategies, that's $1.0 trillion. Alternatives are $0.29 trillion.
Smaller, but growing.
Relatively, yeah. Digital assets, $0.05 trillion. Currency and commodities, $0.10 trillion. And then cash management is $0.93 trillion. So, yeah, equities dominate, but they're managing huge sums across the board.
And who owns those assets? How does it split by client type?
Institutional clients are the largest chunk of AUM, $5.33 trillion. Then ETFs are next at $4.3 trillion. Then retail clients at $1.02 trillion. And cash management makes up the rest, that $0.93 trillion again.
So institutions still the biggest client segment by AUM, despite the huge ETF number.
By AUM, yes.
And finally, the split by investment style, active versus index.
Right. ETFs lead there, again, $4.3 trillion.
You're right.
Followed by non-ETF index strategies at $3.46 trillion. Then active strategies at $2.89 trillion. And cash, $0.93 trillion. Really shows the dominance of index and ETF approaches in their overall asset base.
It's fascinating seeing all those pieces. Now, the report also mentions AUM changes aren't just about flows, right? Markets move, currencies change.
That's absolutely crucial. You can have money coming in, but if the market tanks, your AUM can still go down, or vice versa. For example, their equity business, it saw those decent inflows, $19.3 billion. But it also had a negative market change of $169.2 billion in the quarter.
Oof. So market performance wiped out more than the inflows in value terms for equities.
In that specific period, for equities, yes. It shows how market movements and foreign exchange really impact that final AUM number alongside the flows.
Okay, so even with new money, market swings matter hugely. Let's shift focus slightly now. How did BlackRock's actual investments perform during Q1?
Right, the performance snapshot. As of March 31st, in fixed income, their actively managed funds did pretty well. A good majority beat their benchmark or peer median over 1, 3, and 5 years.
Okay.
And their index fixed income funds track their targets very closely, as you'd expect.
Good to see on the active bond side. What about equities? Active equities had a tougher time industry-wide, hasn't it?
It's more nuanced there, yeah. Their systematic active equity strategies think quant funds actually showed strong outperformance. Over 70% beat the benchmark for the year and over 90% for 3 and 5 years.
Systematic did well. What about fundamental stock pickers?
Less strong, relatively. Fundamental active equity, less than 30% outperformed over the 1-year period. It did get better over 3 and 5 years, but yeah, a tougher recent run. And again, their index equity funds tracked very closely. So yeah, a clear difference between systematic and fundamental active equity performance in this snapshot.
And it's always worth remembering, as the report itself says, past performance doesn't guarantee future results.
Absolutely. Critical disclaimer, always.
Let's move on to how this all turns into revenue.
Yeah.
Total revenue up 12%, we know that. What were the key pieces?
Okay, the biggest chunk by far is investment advisory, admin fees, securities lending, all lumped together. That was $4.40 billion,
Right.
up a hefty $623 million year over year. That's driven by organic growth, market lift on average AUM, and those fees for the GIP deal, partially offset because there was 1 fewer day in the quarter, apparently.
Ah, the calendar effect. So the core business is humming.
Pretty much. But performance fees, on the other hand, they were down quite a bit.
Down. How much?
Came in at only $60 million. That's down $144 million from last year. Mainly reflects lower performance fee revenue from private markets and liquid alternative funds this specific quarter.
Those fees can be lumpy. Right. Depends on hitting certain targets.
Exactly.
But the tech side, that continues to shine in the revenue mix.
Definitely. Technology services and subscription revenue hit $436 million. That's up $59 million year over year, fueled by Aladdin demand and that $20 million kick-in from Prekin. Really highlights how important tech is becoming to their top line.
And distribution fees, advisory, and other, relatively stable.
Yeah, pretty much. Distribution fees, $321 million, up slightly. Advisory and other revenue, $58 million, down just a tiny bit. Smaller pieces of the puzzle.
Okay, now the other side of the ledger. Expenses. Total operating expense was up too. What drove that?
Right. Total operating expense hit $3.58 billion. That's up $543 million from Q1 last year.
Big jump. Where did it come from?
The biggest piece was employee compensation and benefits, up $161 million. A lot of that is the impact of the GIP deal, including some retention costs, presumably.
Okay, people costs related to the acquisition.
Yeah. Then you had higher sales, asset, and account expenses that tends to move with AUM.
Yeah.
And a pretty big jump in general and admin expenses.
What's in G&A?
That included more acquisition-related costs, more spending on tech and marketing, and higher occupancy costs. And finally, amortization of intangible assets, that's like writing down the value of acquired assets over time, that increased by $79 million, mainly due to GIP and Prekin.
So those acquisitions are really hitting the expense lines across the board, which again explains that GAAP versus adjusted profit difference we saw earlier, upfront costs to integrate.
Exactly right. And the report clearly states those specific acquisition-related costs are taken out for the adjusted results, giving that clearer view of ongoing operational profitability.
Okay, nearly there. Let's just quickly touch on non-operating income and tax. Anything notable?
GAAP non-operating income was $65 million, which was down a lot from last year. Adjusted non-operating income, $75 million, also lower. Tax rate, the GAAP effective tax rate was 14.1%.
Pretty low.
Yeah, it benefited from some specific discrete items, things related to capital losses and stock compensation. The adjusted tax rate was a bit higher, 16.0%. And just worth remembering, Q1 last year had a big one-off tax benefit from some internal restructuring, which is excluded from the adjusted numbers, making the year-over-year comparison a bit cleaner on the adjusted side.
Right, context matters. Okay, let's try and pull this all together for you, our listener. What are the really key takeaways from this deep dive into BlackRock's Q1 25?
Well, I think a few things really stand out. First, strong asset inflows, especially into ETFs and private markets, tells you where investors are leaning right now.
Okay, flows showing preferences.
Second, the technology platform Aladdin, boosted by Prekin, it's just continuing its really strong growth. That diversification beyond just managing money seems to be working.
Tech as a growth engine. Got it.
Third, overall revenue growth was healthy, up 12%. That's a mix of organic growth, market help, and those acquisitions like GIP kicking in.
Right, multiple drivers.
And lastly, the profitability picture. Adjusted profit looks strong, up nicely year over year. But the standard GAAP figures were definitely weighed down by the costs of those big acquisitions.
So a strong underlying business, but dealing with integration costs.
That seems to be the story, yeah.
So the aha moment here. Maybe it's seeing how the strong ETF flows show that demand for easy market access is still huge, while the private market interest points to investors still searching for yield or different kinds of returns.
Yeah, I think that's fair. And maybe the other aha is just how seriously BlackRock is pushing into technology. It's not just an add-on. It's becoming a core part of their identity and revenue.
Good point. And for you, our listener, why does looking at BlackRock matter?
Well, understanding how a behemoth like BlackRock is performing, where their money is flowing, it gives you really valuable context on the wider market, investor sentiment, trends across assets, across regions. Their scale offers this unique window into the global financial system, really.
Right. You see what the biggest player is doing, it tells you something.
Exactly.
Okay, so here's a final thought for you to chew on. As BlackRock keeps pushing deeper into technology and private markets, really transforming itself, how might that reshape the whole financial industry landscape over the next few years? What new opportunities or maybe challenges could that create for other investors, other financial firms? Something to think about. We definitely encourage you to check out BlackRock's own materials at ir.blackrock.com for all the details.
Yeah, dig in yourself.
Thanks for joining us on this deep dive.